There's a lot of concern now about the fiscal future of the United States government, and for that matter, whether the U.S. economy is going to grow quickly or maybe even be growing at all for the next little bit. Abe, I'll start with you. Big picture, is the U.S. a good long-term place for an investor to be?
We're value investors, we're global investors, so we can sort of invest around the world. We don't have to invest anywhere, but we do tend to find more value in the United States than we do in some of the more popular areas around the world in emerging markets, for instance. And that's a reflection not of our view on economic growth or macro considerations, but just a function of there being more value available in the United States than elsewhere.
Yeah, Jim, you're looking at big picture themes a lot. What do you think on this question?
Yeah, I think it's very interesting because look at the U.S. and look at unit labor costs. There is a macro driver here. Labor costs are very important here. They're important virtually everywhere in the world. Unit labor costs are rising in Europe. They're rising in Japan. They're rising in most of the EM countries. They're falling in the U.S. And you look at the productivity numbers here and you look at the profit story. We are maximizing the workforce that we've got, and it's accruing to the owners of capital. I think it's a very interesting story.
So that's another vote in favor of the U.S. for a surprising reason, actually, that most people haven't thought about.
Most people, I don't think that way, but it's there, and you can see it in the numbers, and it's been consistently showing up quarter after quarter. Not just the recession; it was showing up before that.
Right, Wally, value investor. What do you think?
Our take is that the debt and the asset bubble that happened were so big and so long in coming that it's going to take a lot longer than people think to work our way through it, and that maybe this is analogous to 1966 to 82 when you had a 16-year period of the Dow was in a 600 to 1,000 trading range. There was a big bear market in the middle of that. Market came back strongly in the next year and a half like we just have, but it was 6 more years before you really went to new high territory.
A discouraging picture.
Well, and it's great for value investors because what we're doing, as Avi said, we're looking for mispriced assets. And if we have a company that's only growing slowly, but it's the perception is too negative, we can have a great time with that, and we'd be fine with 6 years of sideways.
And within the sideways, you can still find plenty of opportunity.
We love it.
Yeah. Dave, what do you think? I mean, you focus, in the funds you manage, you focus largely on U.S. companies. Are you tempted to go outside?
I think the new thing that we're all dealing with is the government intervention, not only here but around the globe. And so what does the government want, right? What is the government trying to do by intervening with, $1 trillion here and $1 trillion there? It seems like, a lot. It seems like a lot of money, and it probably is. It will be more. So I think what they want is they want stability. Right, so they want to stabilize the system. Obviously people don't like the fact that they're intervening, but what they want is important. So they want job growth, they want stability, they generally want low rates, they don't want volatility. So that's what we're going to get, I think, because that's what they're trying to do, and they have all the money. Nobody else seems to have money except the governments around the world, and they can borrow unlimited amount of money, and they'll tamp down any sort of fires that come, both on the upside and downside. And so I think that's going to be what the market's going to be. It's going to be stable, and then it's going to be a function of picking the right companies that can operate in an economy that we have.
Right. Renee, do you agree with that?
I look more, I'm big picture. I'm not a stock picker. I'm a commodity global macro. But global macro, even on the equity market, and I'm a little bit different. The equity markets are the least favorite asset class for me right now.
So up till now, we've been talking about where to buy stocks. You're saying don't buy them.
Right. We think that they're the most overinvested, overvalued asset class in the world because everyone everywhere owns them. And in fact, everyone said in 2008, asset class synchronicity, the whole world isn't decoupling, it's synchronized. Of course the equity markets are synchronized because everyone owns them and owns, in my estimation, or in our estimation, too many of them. But in fact, we have had economic decoupling, significant economic decoupling. between North America, Asia, Europe, and Latin America. We've actually had significant growth in Asia and Latin America with moderate growth in the U.S. So we think that many of these asset classes are going to start to decouple now, and that in fact asset class synchronicity has masked this economic decoupling. And we think that the dollar is going to fall. And so even if you invest in the U.S. equity market and it goes up, on a global basis, you aren't going to keep up.